Hey, you like the new open there? Okay, perhaps you've seen the movie The Big Short about the Great Recession at the end of the 2000s. Well, there are great explainers in that film about a very complicated subject. And some people who knew where to look and who knew when to short the market got really, really rich. But understand, shorting the market is betting against the market. And over the course of the stock market's history, it has made terrific gains. But there have been great opportunities to short it as well. Tonight on Money Talks, we explain shorting the market. As certified financial planner Neil Vinoy explains for us tonight, shorting the market is all about timing.
Short selling is a way to make money when stocks drop. What you do is you borrow shares of a stock that you don't own from your brokerage firm. You sell them for the current price, and your hope is to buy them back later for a lower price and return those shares that you borrowed, and you get to pocket the difference.
Let's let Neil explain what can be a pretty confusing transaction.
Assume that XYZ stock is trading $50 a share. You expect the price to go down, so you borrow 100 shares and you sell them for $5,000. 2 weeks later, if XYZ shares do go down from 50 to 42 and you can buy them back for $4,200, you get to return those 100 shares that you borrowed and you pocket that $800 difference between the price you received when you sold them and what you bought them back for.
And just like betting against the pass line at a craps table in Las Vegas, shorting the market is betting against the market, and many investors have no inclination to do it.
Short selling is risky and speculative, and most investors will be fine without doing any of it, myself included. I don't short stocks ever. Although there are times when stocks drop or they trade within a limited range, the general trend for stocks is positive. So short selling is a bet against the long-term trend.
So you are not betting with the group, you are going against it. And if the stock rises instead of drops, well, I'll let Neil explain.
The price of a stock that you sell short could actually appreciate. And keep in mind, you're going to need to return those shares that you borrowed to your broker, no matter what the price is. So in theory, you could have an infinite loss if the price of the stock jumps way, 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 way up before you can buy it back and close out that position. When you sell short, keep in mind your brokerage firm has the right to redeem those shares at any time, so they can call those shares and you'd be responsible for returning them, even if the price hasn't dropped and you have a loss in that position.
Okay, so what was the greatest market short of all time? Well, in 1992, George Soros shorted the British pound and reportedly made a profit of $1 billion. He sold billions of pounds during the days preceding the British government devaluing the pound sterling in September of that year. Now, much of it was on borrowed money. He then repaid it back, and he has been rich ever since.